That quote by RBI, you're quoting Mahatma Gandhi, I'm moving cautiously at every step, but there is a fixed determination to move ahead. That actually appears to be a risk management measure and a nudge towards risk management than an inspirational quote from Mahatma Gandhi, father of the nation. But let's come back and talk about the policy. We have Siddharth Sanyal to start with. We'll be joined very shortly with other panelists as well. Siddharth, it appeared to me, this policy, that the additional measures which had the last 15 minutes of the policy were much more meatier and appeared much more significant and new, rather than the policy which was more or less on the expected lines and on growth, inflation management and liquidity. So I'll start in reverse, particularly the point on more transparency required for the MSME part, and also the clear mention on fraud and risk on the online Aadhaar based payment. What did you make of it? Are there some practices in the lending sphere which may be making the regulator a bit nervous or cautious?
Well, I think generally the regulator's approach has been a very cautious and well-rounded approach, and that's most justifiable as well. So I think that way, wherever they think not necessarily they might have anticipated something wrong in any of the current situation, but they are trying to make the overall system in a lot of areas a lot more foolproof. So that way, it's not surprising, and possibly that gels very well with Governor's last concluding quote from Mahatma Gandhi, that these are all possibly small steps, but he highlighted the determination towards moving towards one particular situation. Now we can see it in terms of its inflation objective, we can see it in terms of its overall sustained growth paradigm, we can see it in terms of a better functioning financial market or better functioning overall credit market as well. So I think that particular approach can be seen everywhere in whatever they had been doing over the course of the last several years. But importantly, I think it's important to take a quick note of the overall headline initiatives also that they have done, because there was a lot of expectation, a lot of concern around the liquidity situation, not so much on the rates front. And given that the governor tried to explain the situation so very patiently, so very clearly, I think that should help the market.
Actually, for people who have joined in late, let me quickly wrap up what the governor had to say, because it was a very evenly balanced comment that we got from the governor. Of course, no change in rates or stance coming in. He's talked about how inflation has still not reached that target of 4%, plus the transmission of 200 basis points is underway, and that is why there has been no change in stance as well. He also pointed out the public debt increase and how that is becoming a concern, because in advanced economies, the public debt is actually higher than some of the emerging markets, and that is a potential risk point that he pointed out. And this is the first time he spoke about that. A lot of changes when it comes to the GDP and inflation forecast as well. The inflation forecast has been brought down and the GDP forecast has been sharply increased. In fact, for FY25, we were initially working with a forecast of 6.5%. That's been bumped up all the way to 7%. And interestingly, for Q1, they have increased the GDP estimate to 7.2%, because large part of the street was believing that ahead of election, there's going to be a slowdown, but there's almost a 50 basis point increase there. And even on inflation, there has been consistent reduction that we have seen. The CPI inflation now stands at 4.5% in terms of forecast for the next year, while it is at 5.4% for this year. And it has been expected to consistently come down. And by end of next year, it's expected to be around 4.7%. He said that job is not yet done. They're watchful of the conditions. And a couple of interesting measures. Of course, nothing specifically came out on liquidity, but nonetheless, for electronic trading platform, there's going to be a revised regulatory framework. So that will be very important for all you traders who are watching us right now. Of course, for MSME loans and advances, there will be that key fact statement, as well as for digital payment. And I guess this is a focus coming in from Paytm. There will be measures that will strengthen the risk profile as well. We're also joined by other guests as well. Abheek Barua is with us, as well as Nilesh Shah joining us. Nilesh, for the markets, there seems to be a bit of a recovery. At one point of time, it had dipped, but now it's recovering again, plus the fact that the bond yields have also moved in positively. What's been your takeaway from the kind of changes that we have seen in the GDP forecast and the governor talking about how we're at the last leg of managing inflation?
policies as per the expectations of the market. No change in the repo rate. Now, street probably is little lower than the RBI's estimate of GDP growth and little higher on inflation than RBI's estimate for FY25. From equity market point of view, it's priced for perfection, and hence a policy which doesn't change and meets expectation is a non-event. From a fixed income point of view, vote on account laid the path of fiscal glide path, and that resulted into about 10-15 basis point of yield movement downwards. There was not much expectation from this policy except on the liquidity management, and there RBI has said it will be nimble. So for both the markets, this is status quo policy, and hence there should not be any material impact from this policy point of view.
In fact, the vote on account budget did indicate towards the fiscal deficit number, lower borrowing, and that itself nudged, or put the ball towards slightly on the dovish side. This policy's expectation was very, high. But we have Abheek Barua also. Abheek is back with us, and along with that, we also have Tanvee joining us. Come to you. Good morning, both of you. Abheek, time and again, this policy and other platforms too, the governor has mentioned the risk from the exogenous factors. Which are those factors, and how meaningful could that risk be, which could, put the entire equation of risk management, inflation out of the window, or could risk it at least?
I think the biggest exogenous factor is what happens in geopolitics, and particularly what has already happened and the potential spillover effects, for instance, in the problems in the Red Sea. What kind of cost escalation of imports are we likely to see? What kind of supply bottlenecks we are likely to see? So that I think is the principal risk that is there. And then you have you mentioned adverse climate events, which are becoming more and more frequent. So there are a number of potential shocks. We seem to be in a state of, permanent crisis of some kind. But that said, I think if you set those shocks aside, I thought this was a bit of a Goldilocks scenario that he painted. I think the bond market reacted to the fact that he assured them that government spending was coming through and liquidity would be comfortable. But with the kind of growth and inflation combination that he has presented, there is really he's not creating any space for a rate cut anytime soon. So as we push back expectations of a rate cut, it will have to be kind of factored into things like earnings and so forth. So I thought it was more upbeat on growth and kind of a little cautious on inflation. It wasn't in line with my expectations. I thought it would have some room to maneuver and move towards a rate cut and some more explicit liquidity measures, perhaps not a CRR cut, but perhaps some tweak in their existing set of fine-tuning operations, some specific thing to assuage the concerns of the banks and the financial sector.
In fact, that was the sole point this policy. Everybody was looking forward to some hints, some moves, perhaps a CRR, this policy around liquidity. It appears to be becoming a headache. Tanvee, what are your thoughts on liquidity? On the one hand, regulators, bankers, everybody is talking about how large part of the deposits, because credit growth in the system is far outpacing the deposit growth. A lot of money is also shifting to capital markets, mutual funds, which coming out of FDs as extreme as that. And if this issue persists, it could have an impact on the profitability of the banking sector. But what are your thoughts on this liquidity? Perhaps do you see RBI addressing it in twofold, the near-term liquidity issue and slightly medium-term to longer-term issue? Tanvee, request you to unmute your mic, please.
I'm on unmute.
Yeah, please go ahead. Yes, we can hear you.
Okay. So if you look at the liquidity, there are two sources. One is the structural liquidity gap, which is largely because of the gap which is persisting between the credit growth and the deposit growth. In fact, the CD ratio is close to an all-time high. And other is your frictional liquidity mismatch, which is largely happening because of lack of or slower government spending, and which RBI also mentioned that adjusted for that, the liquidity is actually in surplus. So I would say this frictional liquidity mismatch should get soften a little bit as we move towards March and April months. But I'm much more concerned about the gap, which is more structural, especially the credit and the deposit mismatch. Our sense is that it will be very difficult for banks to be able to sustain a 16% credit growth, the momentum you're seeing right now, with a deposit not picking up significantly. So either you increase your deposit base or you slow down your credit. In fact, our estimate is that in FY25, the bank credit growth, which is sustaining at around 16% right now, should moderate towards 13-14%. And this assumes that we will be able to get some 11 to 12% deposit growth, plus India getting added to the global bond index inclusion indices sometime between June and March. That also brings in some $25 billion of dollar flows, which actually boost the money supply. So yes, I think in that sense, frictional liquidity mismatch should definitely soften as government spending picks up pre-elections.
And that's what the governor said, that it seems to be a bit temporary and it will sort itself out as well. But if I can get Siddharth back into the conversation. Siddharth, what do you make of this bullishness that we saw in terms of the growth estimates? Do you think these are realistic, 7%, and inflation also coming down to the levels of around 4.6, 4.7 by the year end? And what does it do to your own expectations of a rate cut?
Well, on the growth front, one would have to give the RBI the benefit of doubt, because the projections they have done of late had actually turned out to be true more often than not, and there had been some upside surprise on growth numbers, at least at the headline level. There can be debate that whether at various pockets of the economy, whether the growth momentum is equally strong or not, and opinions can be very, very different. But at the same time, at the headline growth level, you have to go with the RBI's numbers at this moment. Interestingly, the inflation forecast that they are talking about at this moment, they are talking about anywhere less than 5% inflation number only in the Q2 of the next financial year, which is 5-6 months down the line. Will reach that particular zone. Incidentally, the call that we are maintaining on the rate cut per se is also something very similar. We do expect rate cuts to not to start before the August monetary policy. So that means we are talking about 6 months from now. At least another 6 months, we don't really expect any rate reduction. Having said that, in this particular policy, as Abheek also mentioned, we had also expectation of a slightly more categorical and explicit liquidity support. Governor explained very clearly that structural liquidity is still in positive, but the frictional liquidity part is very significant. And we have seen large banks hiking deposit rates even at the fag end of the rate hike cycle. So I think that particular point, we did expect that there could be some announcement about a longer dated VRR auction kind of a structure where banks would have been getting some more durable liquidity, especially in the months of February and March. But I'll not really be too surprised if we get some announcement in that direction outside the policy over the course of the next few weeks as well.
Nilesh, I'll come to that point with you, because RBI is a pretty conservative institution and a very adept one. Look at how, the RBI governor twice have been applauded globally for their role in the last 2-3 years, especially recovery from the pandemic front. So if they are talking up the growth number back to back in two policies, very small steps, the other global agencies will also look at that very closely. But what about the street? How would street take that? And do you think that the rate cut regime, whenever it starts, maybe mid-year this time around, has it started coming into the price or not yet?
So undoubtedly, in 2024, RBI was way ahead of street in growth estimate, and everyone had to revise their growth estimate upwards. The same thing can happen for FY25. Street is today conservative than RBI on growth estimate, and probably towards the end, it will converge with RBI on growth numbers. The rate cut expectations have been built partially into the current levels. Inflation next year is expected to be around 4.5% as per RBI's own estimate. It could be little higher as per the street, but certainly that lives about 2% real rate of interest, which will be reasonably high. So there is some expectation in the street that as Fed reveals their card by way of rate cuts somewhere in middle of 2024, by end of 24, there is stage set for RBI to cut interest rates, lower down the real interest rate, which are today prevailing at about 2%. And hopefully that will be supportive of growth. And probably that's why RBI's estimate of growth is little higher than the street estimate. And like FY24, street will converge with RBI's number this year also.
Taken. So that's the comment as far as the RBI Monetary Policy Committee meeting is concerned, and the outcome, which was on expected lines as far as the rate action or the lack of the rate action and the change in stance is concerned. But a lot of changes is made in the estimates for growth as well as inflation, and a lot of additional measures that were laid out as well. But we are seeing a reaction in the markets as well. Let's pull up the Nifty as well as the Bank Nifty, because they seem to be slipping. I think the banks are a bit concerned about no particular mention of the liquidity crisis that we seem to be facing right now, because the governor was very categorical in saying that the potential liquidity in the banking system is still in the surplus, while we're not seeing that on the ground. So Nifty Bank has come off materially from the highest point of the trading session. I think we can wrap up our special coverage as far as the RBI is concerned. We should thank all our guests for joining in, right from Nilesh, Siddharth, Tanvee, as well as Abheek, to join us on the show and talk to us about the RBI policy. Thanks so much for that. But since